Hello, and welcome to Tuesday with Lloyd. My name is Enya, Regional Director and National Practice Leader in Risk Management for Lloyd's America. Since September last year, Tuesday with Lloyd has been connecting Lloyd's market and our stakeholders in the Americas region. This year, our sessions not only bring the latest market update by class of business, we've also been showcasing one select syndicate once a month, with the primary goal to help you stay connected with the market leaders and field experts at Lloyd's. Today, it's my great honor to present to you the Energy Roundtable featuring Dominick, Hoare, Group Chief Underwriting Officer, Munich Syndicate, Inkin, Senior Underwriter, Energy and Industry at Amlin, and Rachel Sabbarton, Head of Energy at Canopius. Moderating today's session is Ted Dimitry, Energy and Marine Practice Leader at Higginbotham. Before we start, a couple of housekeeping items. To make the session more interactive, we strongly encourage you to ask questions throughout the session. To help us stay organized, please use the Q&A function rather than the chat box. Today's session is being recorded and streamed live on the YouTube channel, so please share with any colleagues who are unable to join us. Without further ado, let's welcome the panel. Ted, please take from here.
Thank you, Enya. Appreciate it. Thank you all for joining us, and I'm very happy and excited to be here. We'll start off the discussion, basically a quick housekeeping item. We'll proceed through several topics, starting with a statement on the importance of the United States energy sector to the Lloyd's market, moving on to several other topics from there. And to start things off, Dominick, would you please give us a few of your comments on the importance of the U.S. energy sector to Lloyd's?
Of course, Ted, and thank you very much, and welcome everyone, and thank you for this opportunity to discuss the energy market. Well, in simple terms, the US is very important to the Lloyd's energy market. It is actually the cornerstone of our business, and it has been for many, many years. Way back to the 60s, when offshore exploration and production really took off in the Gulf of Mexico, the US were leading that, and Lloyd's led the insurance for that industry. It's been through some difficult times, such as Hurricane Betsy in the 60s, the storms of 05, the storms of 08, but collectively we've always pulled through. And I like to think we deliver great risk transfer to a very vibrant and important client base to Lloyd's and ourselves. So thank you firstly for your support to all those from the US energy industry. It's also worth pointing in mind how important energy is to Lloyd's too. Upstream energy in Lloyd's is about 10% of the overall. I'm probably giving the game away here a bit, but it's also been one of the key profit contributors over the last 5 years. And I think Lloyd's itself, and this is a guess, but it's something like this, has a market share of over 50% of upstream energy business, global upstream energy business. So, not only is the US vitally important to Lloyd's energy is vitally important to Lloyd's too. And I think we'll be talking more about that later. So I think it's a relationship that is the cornerstone of our business, that with the US.
Thank you, Dominick. Chris, can you give us your thoughts, especially from the downstream and petrochemical side of things?
Yeah, thanks, Ted. Similar to Dominick, for the downstream and petrochemical side, the US is a huge marketplace for us. It's grown exponentially over recent years with the midstream sector expanding through the shale gas boom that has occurred in the States. And that's an area we continue to see expanding. For a lot of us, it's probably sort of 50 to 60% of our risk count that we see on a submission basis. And so it remains a very important sector for us, and I think in the coming years will continue to grow. There's also the biofuels and bioethanol sector that's expanding as well, and that looks like a potential new source of business for the London market. So the US is a very key marketplace for us, and a consistent one as well.
Great. Thank you very much. And Rachel, if you would give us your thoughts.
Sure, Ted. Thank you for having me today. I'd echo really what the other panelists have said. I think one other thing I'd add is certainly throughout my career, I've always found US clients extremely willing to engage with underwriters and engage with the market. Dominic mentioned some of the kind of troublesome times that the energy market has been through, and I'd take the Macondo incident as a good example of that. Following that and following the moratorium on drilling in the Gulf of Mexico, it was really how willing clients were to engage with underwriters that allowed underwriters to come back to the table and to continue writing those risks. And that's something that, whilst we're all operating from home at the moment and not necessarily able to meet face to face, that has endured. I know somewhat ironic on a Zoom hosted conference call to mention it, but we're all sort of sick of video conferencing. But it's been really positive that we've got that technology to allow us to continue dialogue with clients. And I certainly feel that I've been able to understand what's been going on with my client base throughout COVID, how they've risen and met those challenges, and how that impacts their overall risk profile. So yeah, just in addition to what the guys have said, a really positive relationship enjoyed, I think, between Lloyd's and their US customer base.
Great, thank you. And I can certainly attest to having been in this business over 25 years, the importance of the Lloyd's market to everything I've done and everything that my clients have needed over the years. I'll move on to the next segment of our discussion today, which is going to be a market update. Chris, I'll start with you. Can you give us your thoughts on the current state of the insurance market from your perspective?
Yeah, certainly. I think over recent years, it's fair to say that the downstream market, from both an underwriter and client perspective, it's been a bit turbulent, to put it mildly. There was a spate of losses between 17, 18, and 19 on the downstream market that hit insurers pretty hard. Conversely, then for clients, their rates have increased exponentially over the last sort of 24 months, which we appreciate has probably not been particularly well received from the client base. But as Rachel has mentioned, we think we have strong relationships and at least an open dialogue with the clients. So hopefully there's at least an understanding of where the adjustment has needed to come from. I think what we are starting to see, and is probably good news for the clients, is that the rate increases for this year, whilst there's still increases out there, they're certainly not as extreme as they have been. I think from my own perspective, most risks have taken most of the required adjustment. For some context, our rating in the downstream world was around historical lows as we came out of 2018. So whilst the rate increases that some clients have seen, which is some 40% compounded to over 100% rate increase over recent years, may seem rather punitive, it's got to be seen in the context of where those rates have come from. And no rate increase is going to be welcome. We do understand that, but where we need to be is at a place where we can provide that longevity that our client base needs and requires from us. And occasionally that does require an adjustment. So I think going forward, we're probably all in a slightly better place because we have a hopefully sustainable rating environment. And those rate movements for the clients, I feel, will probably be tempered over the next 12 months and we'll end up in a more stable world. There has been adjustments to other terms and conditions as well. The main ones that the clients will probably seen invoked quite heavily over the last 2 years is the BI volatility clause. That's prevalent particularly on the downstream space. And that's really just around making sure that the BI numbers that are being presented to us are an accurate reflection. and that's offered some poor loss experience. It's not designed to be a stick to beat anyone with. It's just designed to create a dialogue around the BI numbers, and obviously the intent is that we're just trying to charge a fair price for the exposure, and if that exposure drops, the pricing needs to reflect that as well. So, but I think we're probably transitioning into a more stable world of rate and terms and conditions for the client base in the next 12 months. Notwithstanding that, I will caveat that saying there's been $800 to $1 billion of losses already, and we're in the middle of May.
Fair point. Fair point. Rachel, I'll move to you. Can you give us your thoughts on current state of the market and what you see coming forward?
Sure. I think it goes without saying, really, that 2020 was challenging for us all. For upstream clients, the pandemic and the extreme pricing fluctuations that we saw in the early part of 2020 meant that for many people, activity fell dramatically. People didn't want to drill wells in that oil price, or they chose to shut in production. We also, for US clients, had one of the most active hurricane seasons on record. So a very challenging year all round. The impact of that reduced activity meant that we had less premium income, as less wells were drilled, as less units worked on a full-time basis or worked less than they would normally, and the commodity price for business interruption insurance fell. So it's been a challenge. We've seen some of our clients really struggling. We've seen some high-profile bankruptcies and some restructuring, some mergers and acquisitions. So we certainly recognise it's been difficult times for the industry. In terms of losses and how that impacted the upstream market and is impacting us at the moment, I had a quick look through the Willis loss database, and similar figures really on the upstream side that Chris just quoted. For 2020, there's been about $750 million of losses. To put that into context, that's about half of the 2019 number. Now, there's a little bit of a delay in terms of losses developing, and so you'd expect that number to creep out, but it's not unsurprising that we see a lower amount, given that 2020 wasn't a year where activity scaled back. I think it's probably worth touching as well on what's going on in the renewable energy market, as that forms part of the energy mix, and market conditions that we're seeing there are really quite difficult. Renewables have struggled to return a profit for underwriters for a number of years. Onshore, that's been as a result of large cat activity. We've seen some big hail events in Texas, for example, and that's caused some quite extreme and spiky losses. In the offshore space, there's been a deteriorating construction record. And so in terms of what's going on for the renewable side of the business, we're definitely seeing what we describe as harder market conditions. That's tempered somewhat. There's a large number of people looking to enter the kind of renewable space in response to ESG concerns, but we're definitely seeing harder conditions there, and a more stable kind of background on the upstream side.
Great, thank you very much. And Dominic, we'll wrap this topic with you. If we could have your comments, please. Dominic, you're on mute.
My apologies. What I just said there was brilliant, by the way, as well. I may look at this more of a macro basis and just try and look at the market, where it is at the moment and where it might be going. And I'm going to take the Lloyd's 2020 results as a proxy for the market. And I think that the general assumption is that we're turning the corner, but haven't turned the corner fully yet. There's some work to be done. You know, Lloyd's made a loss last year of nearly £1 billion. Yes, of course, a lot of that was COVID driven. That was 110% combined ratio. If you strip out COVID, it was a 97% combined ratio. Well, given that we've been seeing rate increases now for at least 2 years, not 3 years, and Lloyd's itself got a combined rate increase of 11% last year, 97 on the right side of 100 is not that fantastic result, particularly in an environment of very low investment return. So this is why I say we're turning the corner and we're yet to turn it fully. There's work to be done. Now, I do put my hand up on behalf of Lloyd's that some of that combined ratio is driven by higher costs that Lloyd's has incurred against its peer base. So we need to drive towards greater efficiency, greater automation, and move forward on a lower cost base, and also further reduce our acquisition costs. So, where we're going to go, I don't know. There's a lot of discussion about the tapering of the hard market. The very fact that we're still getting rate increase over most classes, if not all classes, I don't think that's really a tapering of the hard market. I think that is a hard market. We're getting better rate than we did last year, and that is, it says it all. There will come a time when it plateaus out, but at the moment, I think the new capital that's come in is not destabilizing the market. It's providing more stability to the client base in that respect, and that gives you some more choice. But I think the market is being considered in its approach, and dealing with some of these macro issues, at the same time delivering good risk transfer to its client base. So I think that's where I see it sit at the moment. There's work to be done still.
Great, thank you very much. So we'll move on to the next topic, which has generated quite a bit of buzz, certainly on both sides of the proverbial pond. And that is the recent Lloyd's ESG statement and ESG position that it's taking going forward. Rachel, we'll start with you. What are your thoughts on what that means now and going forward over the long term?
Thanks, Ted. First of all, I'll apologise. There's a huge rainstorm going on at the moment, so if you're struggling to hear me, I apologise. Yeah, Lloyd's has published their ESG report, and that's available publicly and for people to read. I think it's really important that people recognise the complexities of ESG. One of the things that the Joint RIG Committee, which for those who don't know is a group of underwriters who work together I hope you can still hear me, it's very loud, who work together from an underwriting, claims and engineering background. That committee is working with Lloyd's to expand upon the definitions and really flesh out exactly what they mean by their report, so that can be communicated to our clients and people can really understand what that means for them and their businesses. Lloyd's has put in place a transition period for existing business, and hopefully that gives brokers and clients time to find and to seek alternatives, and also to work with their underwriters as they transition their own businesses. I think one point I would also make is ESG is at a point where I think a lot of us have to educate ourselves, and a lot of businesses have to improve their understanding of what ESG means. Lloyd's have been very clear in their document. They are working on a framework that underwriters can use in order to make those decisions within their own organisations. And I suspect many organisations like Canopius have their own frameworks in place or are working and continually developing those. It's easy with energy, I think, to focus primarily on the E of ESG, but that's not the whole picture. And a number of people, I'm sure, will have seen stories recently about alleged difficulties with the production of solar panels and potential forced labour situations. So I suppose the point I'm trying to make is that ESG is not single faceted. There's multiple parts to consider, and developing frameworks that allow you to do that is going to be a key part of how we approach this going forward. Going back to my original point, I think when we were talking about why the US is so important to Lloyd's, I think that relationship and the dialogue that we have with our assureds will be a key piece of that. In addition to consulting with Lloyd's, the Joint RIG Committee has formed a sustainability group. I will be chairing that, and one of the key things we'll be doing together, there's about 20 members of that group, and one of the key things we'll be doing is really looking to educate both underwriters and clients as we all navigate this new world together.
Great. Thank you very much, Rachel. Chris, what are your thoughts on this from your perspective?
Thanks, Ted. Yeah, I think sort of from our perspective at MS Amlin, we're no different from any other syndicate or organisation out there. We all have investor pressure. So there's always going to be a bit of pressure on us from an ESG standpoint. We're not immune to that any more than anybody else is. The way that we're looking to move the dialogue as MS Amlin is we're looking towards a conversation more around net zero. It's not about pigeonholing certain market segments or niche areas of a market segment and saying that ticks the box, it's done. We feel that ESG is a wide topic that needs to be taken into account actually across almost all industries, because that's, if we want to take ESG seriously and achieve the stated climate goals of most of the governments that have signed up to the Paris Accord and things like that, you need all industries to do it. It's not going to come just from the oil and gas sector, for example. We believe that the energy mix going forward is still going to contain some hydrocarbons, because our society is built solely at the moment on a basis of hydrocarbons as a fuel source. We can't change that overnight. So all of this is about a transition period, and we've all built Lloyd has built its reputation, and most of our companies have built our reputations on being there for the clients, not walking away wholesale overnight. So we want to be there for the clients and to support that. And we actually believe there's a lot of good things that the energy sector is doing to make the businesses more sustainable and transitioning towards a carbon neutral type environment. What we would like is to engage with our clients more fully on this and actually understand all the good things they are doing, and we can all use that to educate all of our stakeholders so that we're getting both sides of the narrative rather than just one. It's not a case of oil and gas industry is bad. It's a case of we understand that the oil and gas industry is inevitably a reasonable contributor to the CO2 emissions of the world. That's part of that's a byproduct of the business. But there's lots of things that can also be done. Carbon capture, for example, is an area that parts of the US and Canada in particular are quite advanced in versus other areas of the world. And this all should be taken into account in our view. So as Rachel alluded to, everyone's looking at their own frameworks internally for how we can start to differentiate our clients on an ESG perspective between those that are actually quite well advanced within their framework. They've established what their carbon footprint is, they're working to reduce it, versus those that are perhaps doing absolutely nothing. And that's how we see the conversations progressing, hopefully over coming years. But it's about engaging with the clients and staying engaged with them in order to hopefully still maintain the relationships going forward.
Great, thank you very much. Dominic, I'll move to you if you would share your perspective.
Okay. Well, I very much echo a lot of the rhetoric from Rachel and Chris. It is about transition, but it's about responsible transition. I think Chris made a very good point that if we are irresponsible and go for a kind of like a guillotine option and shut off the hydrocarbon industry to insurance product, it'll cause more harm than good, particularly amongst the developing world who really need access to hydrocarbons. And also furthermore, we need to encourage sort of transitional fuels like natural gas as increasingly alternative to thermal coal and oil sands and the like. Perhaps from a Lloyd's perspective, and I just to declare my hand, I am on the Lloyd's ESG advisory group, but I'm not speaking on behalf of Lloyd's here, I'm more speaking on behalf of myself. But as I see it, Lloyd's are typically very reluctant to mandate action. We're a collective market of 50 or so syndicates. To mandate action is not really in the Lloyd's sort of a storybook, if you like. So what they've done, they set out a strategy. And I think the next phase will be some guidelines behind that strategy. And I'm hoping that those guidelines will have a high degree of pragmatism that allow common sense to prevail, allow us as a very mature sector of the industry to actually deliver something that's of value and use to our clients and not sort of kick out just to grab some quick early sound bites in the news and the press. So I think it's got to be a very sort of measured transition. It's got to be a transition, absolutely. I don't think anyone really disputes that. But we've got to be very careful. We've got to work with our client base. We've got to embrace a pragmatism rather than dogmatism. And we've got to listen. listen to all our stakeholders, both internal and external. So I think, I'm looking forward to a very all-inclusive approach that allows business to continue, but at the same time allows Lloyd's and various stakeholders to embark on an ESG journey towards carbon neutrality.
That's great. Thank you very much. Moving on to the next topic, which will be market trends and looking forward, looking ahead. Dominick, we'll circle back with you. What are your thoughts on the market moving forward?
Well, I think it's a very interesting question, and arguably probably the most interesting one so far this afternoon. We've been through an unprecedented period of 15 months, lockdown, working remotely, etc. And there are those of us who look back and say, well, we did it, we achieved it, it was business as usual. Well, yes and no. I think we survived the last 15 months as a market, but did we thrive? Probably not. I think we've been fairly static in what we've achieved as a market. So I'm very much looking forward to a responsible return to office. Our business, as we all know, is very much a face-to-face relationship-driven business. We need to come back together in the City of London, into that insurance community, and rebuild that sense of engagement, single purpose, and community. And we can also reinforce some of the really good initiatives that are underway. Particularly from a Lloyd's perspective, we can look at Blueprint 2, we can look at the drive towards greater efficiency by embracing technology, driving down those costs yet further, and really allow this market to move from that survival phase to that thriving phase. Because let's face it, we are the global specialty market here in Lloyd's. We have a lot of expertise, we have a lot of fantastic infrastructure around us, not least a marvelous broking community. And we need to use that, and we need to use our collective skills, expertise, experience to re-engage and really push forward and deliver a fantastic product to our clients, as well as a cost-efficient product to our stakeholders and our capital providers. So there's a lot going on there right now. Personally, I'm looking forward to that point of re-engagement. I think we can really, not necessarily relaunch, but reinvigorate our marketplace. And I was in Lloyd's yesterday, and I must admit it's quite sad to see the first day of opening. It was very, very sparsely populated, and I hope that starts building up, because in order to deliver our product, we need a relationship. We're not delivering a homogenous product. It's bespoke to each client, and that needs discussion.
Right. Thank you very much. Chris, your thoughts?
I would certainly echo. I'm looking forward to getting back into the Lloyd's market and trading as we used to. As much as we've all survived using Zoom, we deal with a complex product, and it's a lot easier to do that on a face-to-face discussion than it is over a Zoom call or on the phone. I think from a downstream and onshore energy perspective, in terms of new trends, I would say one of the main areas of potential growth where we're just starting to see more risks coming into London is really around the biofuels risks, and the two types of those. We've got the bioethanol plants, of which the US has hundreds, so there's potentially a fairly big market opportunity there. We're also seeing some of our refining clients transitioning to a biodiesel, looking at biodiesel plants, certainly on some of their perhaps less economic refineries. Rather than having those as stranded assets, they're being redeveloped into biodiesel facilities, which I think, whilst they're a very different animal to a traditional refinery in some senses, it allows Lloyd's to go back to what it's always been known for, and that's innovation and dealing with slightly unusual risks compared to what we're used to. So it's an area that I think will grow. I'm aware of a number of them which are under construction at the moment. So I think these will all opportunities and feed into that almost that ESG narrative of the world is changing. We're moving away from just the traditional oil and gas mix and introducing new sources into that, and I think that is something that's going to become increasingly prevalent, both on a US and I expect on a global scale as well. So I think that's something that we've certainly got our eye on going forward. I guess one of the kind of hot topics at the moment, and it's not necessarily a new trend, but it's something that's been on and off the table over the years, is cyber is back in the spotlight following the Colonial Pipeline incident. From our perspective, we're certainly waiting to see what the learnings are that come out of that. It does appear to be a traditional ransomware attack, but I think what certainly surprised me was that it did result in the pipeline actually being taken offline. Some may come out in the press and in the industry in coming months, but I was surprised to see it did have a material impact on the operation of the pipeline rather than simply taking off the normal business computer systems and the like. And I think what it highlights is that as underwriters who are energy underwriters and not specialist cyber underwriters, this is where our gaps in the knowledge of what can and can't happen are probably highlighted, and that's why we do rely on the cyber market actually to provide that cover, because it, certainly speaking for myself, it's not something I fully understand or will ever pretend to. So it's also not something that we look to include in our products. So it's something that we'd certainly be encouraging our clients to be engaging properly with the cyber market to make sure they do have a product that's fit for purpose, not something that's tried to be shoehorned into a traditional energy policy. So I do expect cyber discussions to probably come back onto the radar again after being perhaps a little quiet for the last 2 or 3 years.
That makes sense. I certainly think the days of policies being silent on cyber are a thing of the past.
Definitely. I think it's just more of a case of, for me personally, it's not going down the affirmative cyber route. It's more of being transparent that it's not covered, rather than having any ambiguities or otherwise in there.
Well, that's great. Thank you very much, Chris. Rachel, we'll end with you. What are your thoughts on this?
I think, in similar to what my fellow panelists have said, I think Dominic said kind of we've survived it. I think that's really true. We've survived it, but people haven't thrived. One thing that's really kind of stuck out for me has been the impact on our younger underwriters and brokers. A lot of the survival that we've been able to do, as well as being facilitated by technology, has actually really worked because of really long established relationships. I feel like I'm a broken record here about how important relationships are, but I do genuinely believe that. And a lot of deals have been done and things have continued because people do have that trust that's been built on years of face-to-face transactions. So I think we're all really keen to get back to work and to start kind of collaborating, or back to face-to-face trading, and start collaborating with our own teams and our brokers and the market once more. I think, however, there's really positive things that will come out of this. It's really embraced electronic trading and much more efficient ways of doing things. And we're all human beings. We don't really like change very much. And what the pandemic has done is really forced us to look at some of those things. And I'm sure Canopius is not alone in being an organisation that's really focused on its kind of operational efficiency during this time, and made sure that we're prepared for kind of a new world of work where people can work remotely if they need to, or can work more flexibly, and ultimately have more fulfilling work lives as a result. So I think there's some very positive things to come out of that. I can't remember who mentioned it now, but we did touch on kind of realising the need to realise cost savings at Lloyd's, and technology is a big part of that. For example, we've kind of fully embraced PPL and white space as slip placing mechanisms now, but I don't think people have fully harnessed those in terms of and I won't use the right technological background because I don't work in that field, but in terms of feeding those things electronically into our own systems, and really genuinely driving cost and time out of our business. I think there's a lot of work to be done there. I'm excited to see those things happen, because there's definitely things we can be doing a lot better. Moving on, Chris mentioned some of the new opportunities on the kind of midstream and downstream market. I think I'd really echo that again in the renewable sphere. There's some really exciting developments. In the US, we're coming up to kind of the third offshore wind project, the Vineyard or Vineyard. I'm never quite sure which way to pronounce it. I say Vineyard, but that's probably my love of wine that influences that. Canopius has participated on the previous two projects. That was the Block Island installation and the Coastal Virginia project. We're now looking, those projects were in the kind of 30 megawatt range. We're now looking at an 800 megawatt project, the first kind of real utility scale installation in the United States, as well as the benefits of generating kind of clean energy. That's also going to generate jobs and really help stimulate the economy in that region. So I'm really excited about those benefits. We've got a thriving offshore wind industry in Europe, and starting to see that develop in the US is going to be interesting and exciting for us all. As I touched on earlier, that market is not without its challenges. I can speak about it publicly because it's been put very publicly in their annual report and disclosed, but there are major developers in that sector having real issues with claims, quite significant numbers and quite systemic type issues. So those are real challenges for the market to get to grips with, as well as a kind of ever increasing need for capacity as these projects become larger. The sums insured increase. There's a real need for the insurance market to step up, and if we don't do that, and if we don't do that in a sustainable way, and by sustainable there I really mean in a way that allows insurers to make sustainable profit from this so that they can be in the marketplace on a long-term basis. If we don't do that, that really threatens kind of the future of the energy transition. Banks and funders need that insurance to be in place. So it's a big challenge, but I'm confident that as Lloyd's has done historically, we can rise to that challenge going forward, and I'm really excited to see how that industry develops.
Ted, do you mind if I just pick up on one of the points from Chris regarding cyber and energy business?
Sure.
And I think the reason I want to do this, it's a very good showcase for Lloyd's and innovation at Lloyd's. Lloyd's has got a cyber energy consortium called Stream, and I put my hand up, we lead it, but it's very much a market facility. And it was designed to blend the market knowledge in the energy sector with the market knowledge in the cyber sector. And it provides the traditional cyber cover all the way through the data breach, following and BI, et cetera, but also provides any physical loss, physical damage ensuing from a malicious cyber act. So this is Lloyd's putting together $250 million of capacity. It's innovation. It's there to rise to the challenge of new risk and to cope with the situation where the primary market, energy market, is excluding such risk, but there is an alternative. So I just want to sort of say that from a Lloyd's perspective, it's another great example of Lloyd's rising up to a new challenge, and it's there available and it's up and running.
That's great. Thanks for that. Very, very relevant comment. Well, with that, we'll move into the questions and answers portion of today's discussion. I'll start with one that is relative to the ESG position that Lloyd's has taken. Specifically, the question asks, what are the underwriting and loss trends and differences between insurers that qualify as part of the ESG cohort and those that don't fall within industry peer groups? I'll expand a little bit upon that because I take that to mean, what are the qualifiers from an underwriting perspective, both now and in the future? What will the qualifiers be in the future for companies that fall within or outside of the Lloyd's ESG mandates?
Shall I take that, Ted?
Sure. Yeah, it's kind of open for everybody.
Yeah, so I think my comment on that would be that at the moment, I think that's quite a difficult question to answer. I think that's really what I was saying earlier about a framework for working through ESG. And Lloyd's have said that they'll republish or publish an additional guidance. I think it's in the next couple of months around that framework. But I think it's important to recognise that this isn't about the kind of loss record that an individual company have had. Now, it may be there's underwriting considerations in terms of if a company have had lots of oil spills, you may have concerns about how they're running their operations, for example. So I'm not saying don't take that comment as that loss record is not relevant. Of course it is, but I don't think that that's the determining factor around ESG. Deciding whether something falls within your acceptable limits of or accepted ESG practices is more about a framework around that and the policies and the approach that individual client is taking to their operations rather than to their actual loss record, if that makes sense.
Absolutely.
As I can perhaps pick up on that a little bit further, I have a hunch, and it's only a hunch because I can't prove it yet, but those companies out there that have a strong and robust strategy towards ESG, I'm not saying this could be a coal mine for whatever, but if you've got a strong, robust strategy, I suspect that philosophy transcends all your business issues, including risk management. So I have a hunch that companies with a good, transparent ESG policy and strategy will probably be companies that have fewer losses going forward. That's just a hunch, but be interesting to see.
Yeah, I definitely think the ESG and risk management pieces are they're not necessarily parallel threads. They do intertwine because it comes down to if you're not keeping your product in the pipe, then you're not going to be ESG compliant either. But I do think loss record at the moment sits as a separate conversation under traditional underwriting analysis. The ESG piece is slightly different, but I think going forward, as we'll go down this path, we're going to be looking at ESG in the same vein as we do traditional risk management all the way through. It's just going to form part of the normal underwriting piece, but intrinsically, for me personally, I don't think loss record and ESG would end up with the same underwriting concerns.
Right.
Yeah. I think I'd add one thing further to that. I mean, every client presentation that I've sat in this year has focused in a large part on ESG. This is largely being driven by investors. It's a huge topic for our clients. And to Dominick's point, those who are managing their risk properly, and that's not just their ESG risk, that's their overall risk strategy within their organisation, this will be at the top of their agenda. So it would be to be expected that those who are managing it well will then have better loss records as an outcome of that.
Great. Thanks, everyone. There's one question, probably a little bit geared more towards the downstream petrochemical side. Are there products related to risk transfer and the production of green hydrogen? Chris, you want to lead off on that?
Yeah, I mean, certainly hydrogen production is something that is insured currently in the marketplace. And obviously you've got green hydrogen, blue hydrogen, brown hydrogen, depending on the process that is where it's taken from. But green hydrogen is basically just electrolysis. And it's green because of the power generation that feeds it is deemed green because it's coming from renewable energy. So there's the normal physical damage business interruption market will cover those as they would any other hydrogen plant. For ourselves at MS Amlin, we cover some of the gas manufacturers that are out there, and green hydrogen or any hydrogen would fall into exactly that bucket. So it's a risk that can be taken by the market quite readily at the moment.
Great. Let's see, what steps are being taken to ensure property and business interruption amounts reported by clients are estimated properly? It seems that the estimated values are often understated, sometimes greatly, relative to values claimed after losses, especially in the downstream sector.
I'll say that was probably quite relevant to my part of the business. Yeah, I fully agree that there's certainly been many instances where the numbers claimed don't necessarily tally up with the numbers presented at the inception of a policy. As I alluded to earlier on in the conversations, that's certainly been one of the drivers for the BI volatility clause So you know, when you do the business long enough, you start to get a feel for an insured's BI numbers, and you can benchmark them against the rest of your portfolio to an extent, to just sense check them. So one of the drives that we're looking for on the BI side is a clear and transparent declaration of those numbers and how they've been calculated. It's not just a number on a piece of paper. It's, perfect world, we'll be looking to see how the monthly earnings of a refiner, for example, vary. In the US, you have a driving season, much more than we do in the UK, for example. So we expect to see the margins of a refiner spike during those summer months. All of that just feeds into a bit of a common sense test, and then the BI volatility clause can act as, I don't like to view it as acting like a bit of a stick to beat clients with, but there's brackets that we can give clients as a margin. And to be honest, if the numbers don't quite pass the common sense test, generally those clients will probably end up with a smaller margin of error, all designed to encourage people to redeclare numbers should they move. From a physical damage standpoint, it's difficult. For me personally, I'm looking at when the last external valuation study was. That's really one of the few tools that we have. We'll always try and steer clear from the arbitrary stick of applying an average clause, but that's probably a matter of last resort rather than anything else. I do agree it's certainly been an issue in the marketplace, one without an easy answer, but we will always rely to an extent on just the general premise of insurance and fair disclosure of the risk from the client, which I don't think is an unfair thing to fall back on, but we've all had our fingers burnt over the course of our careers for undervaluation.
Great. Dominic or Rachel, do you have anything to add, even if it's from loss of production income or BI for gas plants or midstream pipelines?
I don't have anything particular to add other than we've seen a fair amount of fluctuation as clients have kind of sought to navigate the commodity price, and underwriters have sought to make sure that the commodity price declared is fair and reasonable. The upstream wording works slightly differently from the downstream wording. So to me, it hasn't been such an issue for us on that side.
Great. Dominic, here's one that mentions you. It says, Dominic mentioned the importance and excitement of returning to the underwriting room. Can each of the panelists comment on their view of the future of the underwriting room? Specifically, do they envision changes in the underwriting room, and more importantly, in a way underwriting will be done in the future?
Okay. Well, I think the underwriting room will change. I think there's probably broad consensus that it will change. But I think we'll still recognize it as being the Lloyd's room of old. There'll still be the need for transactional space that allows face-to-face negotiation for the more complex risks. And let's face it, that's what Lloyd's does best. So we're not going to see that disappear. We'll probably see it shrink. But in replacing that, I hope to see more communal space where we can foster the exchange of knowledge, ideas, relationships. One of the reasons why London is such a successful insurance marketplace is because there's an insurance community here. I used that phrase before. And all communities tend to need a focal point. And Lloyd's is that focal point for the London insurance community. And we need to retain that. It doesn't necessarily have to be floor after floor of boxes, but it does need to be a place where people come to trade, people come to share ideas, people come to swap information, even people come to idly gossip. It's what makes this place tick. We need to ensure we keep that. So yes, it's going to be different, but I hope we can still recognize the good parts of Lloyd's now blended with some newer ideas. And I know Lloyd's done a lot of work on this, and there's been a lot of consultation, and it's something that's been taken very seriously. I'm looking forward to it.
Great. Chris or Rachel, any thoughts or comments?
Sure, I'd echo what Dominic said and agree, really. I think from my perspective, it presents an opportunity to still have that hub and all the positive attributes that Dominic just mentioned, but also to really embrace some more efficient ways of working. And by that I mean, when I started in the market, an underwriter would kind of spend their entire day at the box, which isn't necessarily the best place to look at a wording or do something more detailed. For example, it might be the best place to chat to a broker or to kind of negotiate a specific risk, but there might also, there's lots of deals that might be highly confidential or need to be done in a different format. So I think what this kind of experience has taught us is that we can work in different ways. And again, Canopius are changing our office space. We've moved to a kind of activity-based working scenario where, as well as having the Lloyd's trading floor, we're going to have telephone booths. So if somebody needs to have a telephone conference, they can have that efficiently and privately. If somebody needs a collaborative desk space to work with their team, they can use that type of environment. So I think it's not about taking away from what Lloyd's has or not using that, but it's about using our space in different ways that will ultimately be more efficient and allow us to deliver a better service to our clients.
Great. Chris, any thoughts?
Yeah, I mean, to be honest, I would just echo what Dominic and Rachel have said. I think, Lloyd's, some will argue Lloyd's still uses a slightly outdated model, but personally I'd disagree and say that the face-to-face aspect of it outweighs that idea of it being slightly antiquated. I think with the complex risks in particular, rather than trading multiple emails or submissions via a PPL or a white space type product, a 5-minute conversation can actually save you a lot of time than trying to navigate those. So I think there's a hybrid to be honest going forward. I think for the energy classes in particular, face-to-face still has a very strong position in how I expect to be trading going forward.
Well, I can, from my perspective as a broker, early in my career, I had the fortunate opportunity to work in London, and it was amazing how much could get done in a day. Going from box to box, getting things agreed, having several conversations, and from a U.S. retailer standpoint, if you're trying to put together a facultative program using markets, whether they're domestic U.S. markets or just other markets outside of Lloyd's, it could take you 2 weeks to get done what you can accomplish in a day in London. So I'm also looking forward to being able to return as a visitor with clients, which is always kind of fun when you have your client, it's their first trip into Lloyd's and they sort of walk around with their mouths open. It's really fun to do that.
We need to get back supporting the bars and restaurants around Lloyd's as well, and contributing to the thriving social scene. I think that's really important.
For sure. Another question, it's a little more technical. Given underwriters' reliance on natural catastrophe modeling, how else are insurers accounting for the uncertainties related to climate change when dealing with changes that take decades to emerge?
So there's currently, if you look at that question in terms of what extent are we adequately capturing climate change in our current pricing, if you look at it from that angle, and there's currently a Lloyd's thematic review going on of that very topic. We have a reasonable amount of confidence that the models that we use do take into account those things. So they do allow kind of materially complete pictures of climate change. Now, we know there's things that they don't adequately take into account, such as sea level rises or things like that. And we can build in elements of kind of contingency for those. I think where it's much more difficult is if you look more away from kind of the property side and probably more into the casualty side of insurance. It's a lot harder to predict how something like climate change will impact those classes. However, I think it's about being aware of it. If it's on your radar, if it's part of your business planning and something that you factor in, any guess that you make is never going to be it's never going to be correct, but it's about whether you're trying to logically include an allowance for that, and also from a liability perspective, how you're expecting such losses to come in. If something's not going to develop for decades and decades, you're probably not expecting to see, what type of policies are you writing? Are you expecting to see losses today, or are you expecting to see losses in the future? So it's quite bespoke to the individual piece that you're looking at. But I would say, certainly from a Canopius perspective, we have a reasonable amount of confidence in models, in the context of how much confidence you can have in models. They are only models, but we do feel that climate change is taken into account in that, and where we don't, we make additional allowance for that.
I think it's a very difficult question. Dare I say, insurers tend to be very reactive. We tend to look forward by using the rearview mirror, and I think we are a little bit guilty of that. I think with climate change as we speak. However, I also think we are very aware of the issue, and I think we are always, it's a dynamic pricing environment we move in. We're not, as Rachel said, locking in price for the next 10 years. Typically, we lock it in for a year, so we can always factor in change. But I think one's got to be also very careful. One looks at sort of the hurricane season in 2020, and one can throw one's arms up in horror and say, we went through the alphabet twice, life's changing, we need to double our prices. Well, we do have extraordinary years. And I remember back in 2005 and again in 2008, when people were looking at me saying, that man's bonkers, he's mad. Why is he writing Gulf of Mexico windstorm business? Every year is going to be a wipeout. Well, it wasn't. So I think one's also got to have a sort of grasp on reality and accept there is going to be extraordinary years, but that's not necessarily going to be every year. So it's continuously could be dynamic, listening, learning, looking, readjusting, as well as respecting, the elasticity of pricing too.
Right. Chris, any thoughts on that?
No, I mean, I think the guys have covered it well. I think the models are fairly robust. Certainly, if we're looking at US models, there's huge amounts of data there to give credence to the numbers that come out. So I think from our perspective, we're relatively comfortable with the current models. The world will evolve, of course, should climate change happen as severe as some would suggest. But by the same token, we can't factor it. It's a case of you don't know what you don't know, effectively, and we can't preemptively factor that in. If we factor that into a client's pricing, I don't think many clients will be thanking us for that either. It's just something we need to evolve as the situation arises. It is slightly reactive, of course, but that is the world of insurance at times.
Right. Well, we're running up against our time, so I'll offer it up to each of you for concluding remarks, maybe 60 seconds apiece.
Just to say thank you very much for listening to us. I really enjoy such opportunities. I've been working in the Lloyd's market for whatever 30 years. I'm passionate about it. I think it's a remarkable market for remarkable people, and I think it's fantastic years ahead of us. And the one thing I would like to really sort of put out there as a plea to the Lloyd's market collectively is that we've got one really important weapon in our arsenal, and that's data. But we're not bringing that data together collectively. I think Lloyd's could be a really even more powerful marketplace if we centralize our data, bring it together. I think under Blueprint 2, I think we see the first really good steps towards that.
Yeah, I'd just echo Dominick's thoughts and say thank you for listening to us today. I've banged the drum about relationships and how important they are, and I just encourage our clients to keep talking to us and keep being open with us. The more that we as underwriters understand your risk, the more that we can offer you the best products and the best prices to transfer that. So I just really encourage that openness as we all navigate the challenges that life throws at us. None of us would ever have thought at the beginning of 2020 we'd be working from home for over a year. So who knows what the next 5 years will bring, but let's keep talking and navigating our way through that.
Sounds great. Chris, any thoughts?
Yeah, I mean, certainly I'd just like to thank everyone for the for listening to us and the opportunity to discuss the topics. Obviously, there are some difficult topics out there. Just like to reiterate from an MS Amlin standpoint that we are looking to be a long-term partner with our clients, and that might mean we will ask the clients for some more detailed information going forward, but it's all with the intent of being able to support everybody going forward and remaining a long-term consistent partner.
Great. Well, thanks everyone for participating today, and I want to thank you, Enya, and everyone at Lloyd's for allowing me to moderate. And with that, if you have any comments, we'll hear from you.
Absolutely. Thank you so much, Rachel,
Thank you.
Chris, Dominic, and Ted for the session and for your insight into the energy market. Special thanks for your passion, commitment, and leadership, which is so obvious and so inspirational to us. Thank everyone for joining us today, and hope to see you again on the next session, which is Tuesday, June the 8th, when we will showcase Dale Underwriting as a syndicate. Their CEO and their active underwriter, Dale Duncan and Dominic Peters, will join us live from London. At the end of the session, please take a moment to finish the survey, which will help us in future programming. So let's stay connected, and we look forward to seeing you on June 8th. Take care, everyone. Thank you again.
Thanks, everyone.
Thank you.
Thank you.